Good morning. It is Sunday, March 16th, 2025. It is just after noon on the East Coast. This is Robert Sin at CEO Technician on X, at Goldfinger on CEO.ca, and this is Goldfinger Capital on YouTube. As always, if you enjoy this content, if you get value from it, something of interest strikes your fancy and what I'm talking about, please hit the like and subscribe button to continue to grow our audience and attract more like-minded people and investors. A lot to be grateful for this weekend, just something I'd like to start off with. Despite the rocky overall stock market and negative consumer sentiment, a lot of good things happening as well, especially in precious metals and junior miners. We'll talk a little bit about that later. But let's start with the broader market, the macro. We get word of a China stimulus this weekend. This is a bigger stimulus. I mean, this article was written on Friday, but there's an announcement today. These China policy actions, sometimes they're a little difficult to understand, but it seems to be a pretty broad action to stimulate bank lending, to stimulate consumer spending, government trying to help out the little guy. So it seems very positive, and it seems quite substantial, something that China needed. And it's just interesting to know, just by looking at the FXI, that it's making 52-week highs right now. And actually, China has been one of the best performing markets so far in 2025. And it's always interesting to look back at the beginning of the year when we flipped from 2024 to 2025. Well, sentiment on US stocks was pretty bullish. Some might say frothy. And sentiment on China was very negative. China, I mean, obviously we know they're dealing with a debt deflation, a property bubble overhang. Yeah, and look at the performance, right? So very negative sentiment on China at the start of the year, very bullish sentiment on US mega caps like Nvidia, like MicroStrategy, like Tesla, and just look at the contrast in the performance, right? So if there's one thing that you take away from this video, it's to really be a student of investor sentiment. And when sentiment reaches extremes, it's usually time to fade that extreme sentiment, right? So I would say China negativity was sort of at an extreme walking into 2025. And maybe optimism on US exceptionalism was also at an extreme, right? And fading those two has been pretty profitable so far. Treasury Secretary Bessent, he's been doing a lot of interviews. He's not afraid to speak. He likes to get out there in the press, right? And so this is hot off the press here Sunday morning. And there are no guarantees that there won't be a recession. And he says robust policies that will be durable. That's sort of boilerplate language. Robust policies that will be durable. Okay. But key points. I'm not worried about the markets. They've been consistent on this. We're not looking at the stock market day to day. We're focused on the long term. If we put good tax policy in place, deregulation, and energy security, the markets will do great. We've been in for 8 weeks. We're putting the policies in place that will make the affordability crisis go down, inflation moderate. I am confident the American people will come our way. So this is their very clear to understand. They're not backing away. The 10% correction in the S&P 500, the administration is not backing away. The Treasury Secretary is staying on message. So I think we have to stick with the thesis that they're going to be unmoved by market volatility, and they're going to stick to their policy goals, right? And they've been consistent. They want to get 10-year Treasury yield down. They want to get inflation to moderate and get rid of this affordability crisis. Affordability crisis is just housing, rents, things consumers consume, right? But it's interesting to see their messaging and contrast that with some data out there. So I'm going to sort of skip ahead here. Record high of consumers think business conditions are worsening. I mean, look at this graphic. It goes back to 1980. Um, I'm not sure if anybody here recalls 1980, but I certainly know the history. And 1980, 1981 was not a great year in the US economy. There was a recession. Inflation was really high. Uh, yeah, so back then, this survey was still registering lower than it is today. And interest rates, inflation were near 20% in 1980. So this is pretty significant that the negativity is so palpable right now. It's incredible. And any time that we had a big uptick in this survey, essentially, that consumers expect business conditions will worsen in 1 year, every time we've had a big uptick, 2008 financial crisis, early 90s, that was a recession, early 80s, that was a recession, right? But it's become, I mean, this is completely unmoored from its historical range now, right? I mean, if this was a stock, this is a breakout, right? So it's very interesting to see that contrast. This is from Goldman Sachs. Long only hedge funds have liquidated $15 billion worth of US equities the last couple of weeks. So you add it all up. I mean, the deteriorating consumer sentiment, clearly investor sentiment also deteriorating. And then we're getting confirmation from the airlines and other sectors of the economy that consumers are in a sour mood, right? And really, the airline stocks, wow. American Airlines trading under $11 a share. So I remember thinking back to the COVID crisis, let's say April, May, June 2020, American Airlines is back to those levels when they weren't even flying planes, right? In 2020, right? Obviously, government did some extraordinary actions in 2020, but if we contrast this level of negativity that the airline industry is facing right now, it's literally bordering on when the world was shut down. So this is pretty extreme. I'm just going to say, yeah, I don't have any deep insights into the airline industry and the future course of consumer spending on travel, but it seems to me, just from being a student and observer of market sentiment, that this is now at a sentiment extreme, a negativity extreme. And the chart is basically falling off the page to the lower right. And I would say that I would put the odds in favor of this negativity being a little overdone in the near term, and high probability, 65, 70%, somewhere in that neighborhood, that we get a snapback rally. Maybe American Airlines trades back to $12. Maybe it trades back to $13. I'm not exactly sure. But just from a trading standpoint, I think you can safely risk 10% from these levels, maybe stop loss under $10 or $9.90, and take a shot here from the long side, because the negativity is really extreme here. And that's kind of my call for the broader market. Look back at my previous videos, my Substack posts going back 2 to 3 weeks. I turned pretty negative on this stock market in February. Absolutely the correct call. I would say it's time to sort of fade this negativity in the near term, that there could be a relief rally. How far that goes, it's never easy to guess, but just looking at charts here, 100 to 150 points on the S&P, maybe putting us back, talking about the E-mini, 5750 to 5800. If we're talking about the SPY, somewhere near 575, maybe as high as 578. on the SPY exchange traded fund. Those would be my upside targets. This could happen Tuesday, Wednesday, Thursday. It could happen this week. That's my super short-term call. Stocks like Tesla, MicroStrategy could certainly have further upside. But at some point, probably going to turn into a sell again, because I just think that the macro conditions and what kind of major shifts that are underway with the new Treasury Secretary, the new administration in Washington, it's more likely that stocks trade in a range, could be a volatile range, for some time, at least another couple months, because the changes, the shifts that are underway are going to be uncomfortable at times. Clearly, people are uncomfortable right now with tariffs, with some of the geopolitics, some of the rhetoric from the new administration about Europe, about Canada, right? This is not something that we're used to, right? It's not something that Americans are used to from a president, or even citizens of the world are used to coming from the United States of America, right? So it's going to take some time to get used to, but I think we need to not lose our optimism. I think the pessimism is probably a little overdone right now in the near term, right? So that's sort of my call. Let's say 1 week call that stocks could have a further bounce. They started to bounce on Friday. So let's see. Uber. Barron's has a bullish piece on Uber. I'm long Uber. I like this setup here just from a chart standpoint, retesting that $70 support level. I don't think we can overstate how important that $70 level is. So far, that support level is holding. There's been a bit of negativity on autonomous driving, Waymo hurting Uber's business. But Uber's business is more diversified than just ride sharing. I mean, Uber Eats is huge, right? They have multiple channels to their business, right? It's not just ride sharing. And actually, it's more likely that like companies like Waymo will use Uber's platform, because the Uber app is on more than 171 million phones globally. And its businesses include Uber Eats, include advertising. They're well diversified past just providing cars to passengers, right? And Barron says now looks like the time to buy. I mean, this is a cash cow business. They're generating heaps, billions of free cash flow. I think the free cash flow forecast for 2025 is somewhere on the order of 8 billion or 8.5 billion. Yeah, I think Uber is a buy down here. So fade the stock market and consumer sentiment negativity here in the near term. I like Uber against that $70 level for a trade. So let's get rid of these charts. Treasury yield. So clearly the new administration, the Treasury Secretary, continues to stay on message that they want to get interest rates down. They want to make housing more affordable. They want to make all kinds of aspects of consumer activities more affordable. So I feel like that means that there's a new ceiling here on the 10-year. It's probably around 4.4%. I'm not even sure it's as high as 4.5%. I think it might be 4.4%. From a technical standpoint, this is sort of like a bearish flag, or you could call it a bearish wedge. So maybe a little further upside here, up to near 4.4%, but then this is going to be a fade. That will mean bonds will be a buy again. And very likely that I see this 10-year testing that 4.1% yield level again in the relatively near future, let's say the next couple months. And then we'll have to see. But if suddenly the economy does deteriorate further and the Fed is going to bring some rate cuts forward, I mean, I think June is going to happen, but I mean, if they push it forward to May, we're definitely going to probably see that 4.1% yield level on the 10-year tested. But I think that you'd rather err on the side of being long Treasury bonds here, just because of the policy goals in Washington. So turning to gold, couple of pieces that I think are worth reading. This is an excellent Substack author, Wendy, and she writes about gold this weekend, right? And there's this quote, which I think is fantastic. Gold has no nationality, and it's universally accepted as the unalterable fiduciary value par excellence. That's from former French president. Um, and then going further, she gets into a lot of important data, facts, and let's still further in here. She goes through the history of U.S. gold holdings. And I think it's very important to understand that Bretton Woods happened in 1944, and the U.S. gold holdings in the early 1900s were not necessarily that significant, on the order of like 200 or 300 tons. A lot of it had come from like gold rushes that occurred in the West, like the California gold rush. But the U.S. wasn't accumulating gold from other countries at any substantial scale. That changed with World War I and World War II. The United States turned into a gold magnet as the U.S. became a manufacturing juggernaut, right? And other countries were paying the U.S. for everything involved with the war effort, and including agricultural commodities, et cetera, right? Goods and services were flowing out from the U.S. and gold was flowing into the U.S. So U.S. gold reserves peaked in 1952 at over 20,000 tons. Well, today they're just above 8,000 tons, right? Then in the 50s and 60s, the U.S. went through a period of gold flowing out to the rest of the world as the rest of the world sold their goods to the U.S., to the rich United States, right? Uh, the victor of World War II and the global, reserve currency made the U.S. a consumer of everything from the rest of the world, right? So this is a great history lesson in here, chock full of data. And she just talks about the potential for a gold revaluation and maybe what the Trump administration is thinking. And my Substack post from last week, talking about the era of $3,000 gold has arrived. And really, the main gist of this is that the economy is going through an adjustment period, right? That is going to be difficult and uncomfortable for many. And some of these layoffs are strong evidence of that. Some of the data we've gotten recently in February and March is more evidence of that, confirms that. And then the stock market price action, again, is even further evidence, real-time evidence, because remember, the stock market is in many ways the leading indicator for everything, right? The airline stocks were in pronounced downtrends in February. And then we learned from Delta and American and Southwest in March that, yeah, it's not going so great, right? So the stock market knew what was already happening underneath the surface, right? And, the fact that we walked into 2025 in this new administration with very high equity valuation levels, of heavily inflated stock market, stocks like Tesla and NVIDIA trading at absolutely astronomical valuations, right? And even MicroStrategy being trading at such a premium to its net asset value, right? There's froth, right? There's froth in certain areas of the mega cap stock universe in the U.S. And so, as a correction has been underway, there is a negative wealth effect. Definitely, the last couple of months, people who are heavily invested are feeling some pain, right? And that's going to cause them to pull back on spending in other areas of their lives, right? And that's what happened in basically 2000 and 2001. There was the popping of a tremendous stock market bubble, right? Like March 2000, valuations, whether it's Cisco, broadcast.com, Yahoo, whatever, the valuations were absolutely insane. And people had a lot of wealth in their equity portfolios. Well, fade the scene a year later, most of that was wiped out, right? And that had a negative effect on the economy. So basically, the popping of an asset bubble in 2000 and 2001 generated a recession and a big uptick in the unemployment rate from about 3.8% at the low in 2000 to 6.3% at the high in 2003, right? Um, and during that time, gold was beginning to move higher. And then it really took flight um, as China came into the market in a big way, right? In 2003 and 2004. And we had the commodity boom, right? And then the global financial crisis, and I'm not going to go into all those details, right? But as the Fed arguably made a policy error in 2000, that put the bottom in place in gold, right? And arguably the Fed made policy errors in 2021 and 2022, and the Fed may be making a policy error right now. It remains to be seen, but the fact that they're holding off on cuts because they're worried about inflation, well, it's interesting because what if inflation just U-turns lower here in the next few months, which there is some evidence that it could. Um, well, it's unclear what exactly the policy error might be. It might be not cutting, or it might be panicking and cutting, right? Some people argue their September rate cut, 50 basis points, was a policy error that helped inflation to rebound, right? It's interesting, but gold. So if we just study the gold price action, gold is telling us that there's a policy error unfolding here, right? It's sniffing out uh, something not great happening, and that could just simply be stagflation, right? That could be the economy is weakening substantially. We saw Goldman Sachs lower its GDP forecast for 2025 from 2.2% to 1.7%. So it could be the prospect of a decelerating economy with stubborn levels of inflation, right? But the era of $3,000 gold has arrived. Please subscribe to my Substack so you get all my content as soon as I put it out. You get the best of the best there on Goldfinger Capital. So gold has had a tremendous move. I don't have a short-term forecast on gold. I've said stick with the trend. I think I'm just going to keep saying that here. There's no reason to alter at this point, although, obviously it could have a pullback at any moment because it has had such a big run. But the gold miners are beginning to enter a bull market here in 2025. I mean, look at where this sector started the year. Think back to the sentiment on the sector at the end of December, and then look at the performance here in the first 2.5 months of 2025, right? The performance has been pretty good. A lot of gold producers are up 20%, 25%, some even 30%. And we're seeing evidence that some juniors are beginning to get bid up, right? Um, the highest quality juniors are outperforming. They're performing very, very well, frankly. Some companies that broke out last week, just off the top of my head, Nucor Gold, top performer. CNL in Colombia continues to put out incredible results, right? So this is a bull market, dare I say. Just looking at the price performances, looking at the charts of some of the major gold mining stocks, AEM is now the super heavyweight champion in the gold sector with the largest market cap of any gold producer in the world. It's above 52 billion US, slightly edging the former champion and long-standing champion, Newmont, at around 51 billion US. And Newmont is still the biggest in terms of its annual production, above 6.5 million ounces. But Agnico is just so much better at making money from mining gold that it's being given a premium multiple, a premium valuation multiple that has its market cap above Newmont, despite the fact that it produces almost barely more than half as much, right, of gold ounces per year, right? So that's interesting that generally a smaller company can have a bigger market cap. And that tells you that profitability matters. That's why these companies are doing what they're doing. They're trying to maximize profit per ton of earth moved. And then juniors. So we'll finish up here with some comments on the junior mining sector. So this is a premium Substack post for paid subscribers, just giving you a little tease here, some of the companies that are mentioned in here. But, drill programs that are now underway of companies I own and follow, Ramp Metals in Saskatchewan, following up on that really high grade gold discovery at the Ranger target from last year. That was 7.5 meters, grading 73.55 grams per ton. Well, I'm not sure drilling has started just yet, but it's starting this coming week at Ranger. So that's super interesting. I look forward to more details from the company on their targeting and sort of the strategy for this drill plan. But definitely they need to get more holes in there around the discovery in hole number 1, the only hole they drilled at Ranger in 2024. They just need to drill around it to get a better understanding of the geometry of the ore body, right? And then they have 2 other target areas too. So it's not just all about Ranger. It's also about Rush and Rogue. Rush looks particularly interesting based upon the data they put out to date. Ridgeline Minerals at Big Blue, copper gold porphyry project, that is underway. That hole is, I think, getting into like 200 meters depth or maybe even more at this point. First Atlantic nickel phase 2 drilling underway at the RPM zone as of this weekend. They put out news, the metallurgical test results. I talked about that in my premium Substack post, but very good results. I mean, it was better than I even expected, quite frankly, right? And they have chromium too. So it's not just nickel, it's also chromium. So that's going to be really interesting to see if they continue to build scale at the RPM zone and test some of these other zones there in Newfoundland. And then drill program set to commence in April. Banyan Gold, that's going to be starting in early April. They just closed the financing. Eloro, that tin domain, they've had some really good drill results lately. ELO on the TSX, they're going to be following up on those good results in the tin breccia domain there in Bolivia. And then Hercules Metals, obviously, the company officially says May 1st, but I'm going to bet that they'll get underway the last week of April there in Idaho. That's going to be a highly anticipated and followed drill program, because it seems like they're really honing in on some areas of the property that haven't been. Yeah, so the Hercules drill program in Idaho will be highly anticipated, and that will get started within 6 weeks. And then the final topic, First Quantum, Cobre Panama. It looks like some positive things are happening there in Panama. There's this article on mining.com saying that the president of Panama will allow his government will allow the export of 120,000 metric tons of copper concentrate that has been stuck since the mine was shuttered. That's a lot of copper. 120,000 metric tons. That's a lot of copper, right? I don't think that's going to hit the market tomorrow, but if that comes into the market in the next month or two, that will definitely help to bring some new copper supply and maybe bring the copper price down a bit, cooling off from its recent rally. And then it seems like the body language is very good that Cobre Panama could move back into production. The fact that First Quantum is suspending its arbitration against the Panamanian government, a very positive sign. First Quantum share price has definitely reacted favorably. And, this is not like it's going to come back online next month or even possibly this year. Even if they get all the green lights from the government, it might take 12 months to get this massive copper deposit, this copper mine back online. But that will be much needed and very good for the global copper market, helping to rebalance a tight global physical copper market here in 2025. And then just pulling up this ramp chart, I want to make a comment. This is the Saskatchewan Gold Explorer. This company has a relatively tight trading float. It has a relatively tight share structure. It is high risk because it's a completely new discovery, a blind discovery where they don't even understand exactly what is going on there and what drove the gold to be in such a high concentration at this Ranger target. So it needs a lot of confirmation. It needs more drilling, and expect the share price to be volatile, especially with this thin trading float. But I like the chart here, and it's consolidating in a very healthy way. A small uptick in terms of wider appreciation by investors could drive this to new highs above $1.40 a share. Again, 73 grams over 7.5 meters. Man, if they follow up with even half of that, it could be fantastic for shareholders and the share price. On the other side, if there's disappointment, this thing could definitely break back down through $1 and maybe even retest those November lows there around 70 cents. But it is a tight trading float. It is a tight share structure. Management has a lot of skin in the game here, and the company has 4.5 million Canadian in cash. So ramp is definitely one to watch here as phase 2 gets underway at Rottenstone Southwest in Saskatchewan. Again, thanks for tuning in. I really appreciate your time and attention. And again, if you found value in this video or in any of my content, please hit the like and subscribe button and have a powerful trading week.